Imagine building a bridge, rated to carry 10,000 pounds. Now, how much weight would you actually drive across it? A smart engineer builds it to hold 30,000. That gap, the difference between what it can hold and what you ask of it, that's the single most important idea in all of investing. Right, margin of safety. I've spent 50 years watching investors win and lose fortunes. And the ones who blew up, they almost always made the same mistake. They paid full price for the future being perfect. Here's the truth nobody likes to hear. You will be wrong. Your estimate of what a company is worth will miss. The economy will surprise you. So the question isn't how to be right every time, it's how to survive being wrong. That's what margin of safety does. And by the end of this video, you'll understand the exact idea Benjamin Graham called the central concept of investment, plus the third example, where it saved Buffett from a scandal, is the one most investors have never heard. Back in 1949, a professor at Columbia named Benjamin Graham published a book called The Intelligent Investor. Warren Buffett later called it the best book on investing ever written. And in the very last chapter, Graham gave away the whole secret in 3 words. He wrote that if he had to distill the secret of sound investment into a single motto, it would be margin of safety. So what does it actually mean? It's simple. Every business has a rough value, what it's genuinely worth based on its earnings, its assets, its cash flow. Graham called that intrinsic value. And then there's the price, what Mr. Market is asking for it today. Draw, intrinsic value, what it's worth, versus price, what you pay. The margin of safety is the gap between them. When you buy $1 of value for 60 cents, you've got a 40-cent cushion. If you're wrong about the value, if the future disappoints, that cushion absorbs the blow. Graham didn't say buy great companies. He said buy them cheap enough that a mistake won't ruin you. But here's where most people get it backwards. This is the part that trips up almost everyone. People think a falling stock is a bad investment and a rising stock is a good one. Graham's student Warren Buffett put it better than anyone. Right, price is what you pay. Value is what you get. Price is what you pay. Value is what you get. Those are 2 completely different things. And the whole game is buying when the price is far below the value. Think about it like buying a house. If a home is genuinely worth $400,000, and panic in the neighborhood lets you buy it for $250,000, you didn't take on more risk. You took on less. Draw, house worth $400K, panic sale, you pay $250K, lower risk, not higher. A lower price, for the same asset, means less risk, not more. That's the opposite of what Wall Street tells you. Wall Street says a rising price is safety. Graham said a low price relative to value is safety. And in 2008, the whole world got a live demonstration of this. The market fell about 57% from its 2007 peak to March of 2009. Wonderful businesses were on sale. The people who saw value where others saw only falling prices, they made the buys of a lifetime. But how do you actually build that cushion into a real decision? Let me show you 3 examples. Let's start with where it all began. In 1948, Graham's firm bought roughly half of a small insurance company called Geico for about $712,000. It became the single most profitable investment of his career, worth many times what he paid. He bought it because the price was a fraction of what the business could earn over time. Margin of safety in action. Now Buffett. In 1988, he began buying Coca-Cola. By 1994 he'd spent about $1.3 billion building the stake. Why then? The stock had struggled after the 1987 crash, and Buffett saw a brand and a distribution moat the market was underpricing. That stake is now worth over $25 billion, and it pays Berkshire more than $700 million in dividends every single year. And the one most people miss, American Express. In 1964, a scandal called the salad oil scandal crushed the stock. A company had used fake vegetable oil as loan collateral, and Amex was on the hook. The price collapsed. But Buffett walked into restaurants and saw customers still using their Amex cards. The scandal hadn't touched the actual business. So he invested heavily while everyone else fled. The gap between the panic price and the real value, that was his margin of safety. Draw, scandal price crashes business intact, Buffett buys the gap. 3 different decades. 3 different industries. 1 identical idea. But here's the mistake even smart investors make. The most dangerous words in investing are, "this time it's different." When people abandon margin of safety, they're usually paying up because they're certain about the future. And certainty is exactly the thing markets punish. So how do you build a cushion in practice? First, estimate value conservatively. Use cautious assumptions, not rosy ones. If it still looks cheap under pessimistic math, that's a real margin. Second, insist on a discount. Graham often looked to pay no more than about 2/3 of what he thought a business was worth. That 1/3 gap was his protection. Third, remember the cushion is for your errors, not the market's generosity. You're not trying to predict the price tomorrow. You're making sure that if you miscalculated, you don't get wiped out. Draw, conservative value big discount cushion for your mistakes. Because you will misjudge things. I have, plenty of times. The margin of safety is what turns a wrong guess into a small loss instead of a catastrophe. And that changes everything about how you sleep at night. Right, the cushion is for when you're wrong. Here's the one thing to carry with you. Investing isn't about being right. It's about being protected when you're wrong. The margin of safety doesn't make you smarter, it makes your mistakes survivable. And over 50 years, I've learned that surviving your mistakes is what lets compounding do its quiet, patient work. This is educational content, not financial advice. Always do your own research, and remember that past performance never guarantees future results. So let me ask you, what's one investment where you wish you demanded a bigger cushion? Tell me in the comments. I read them, and the honest stories teach all of us. And if this changed how you think about risk, hit subscribe. We do this every single day. Tomorrow, we're breaking down how to actually estimate intrinsic value, the number this entire idea depends on.